Welcome back to Economic Insights. I'm Alex, your host, and with me as always is Selim, market veteran, show producer, and the man who's been navigating these waters for longer than most of us have been paying attention to them. Selim, great to have you.
Great to be here, Alex.
What a week. I don't even know where to start. Missiles, tariffs getting thrown out by courts, AI chaos, feels like we're collecting crises at this point.
You're not wrong. It was one of those weeks where every time you thought markets could breathe, something else came along to knock the wind out of them. Two very distinct drivers, though: the US Iran situation and the courts slapping down Trump's tariff powers. Both matter enormously for markets, and we'll get into both.
Let's start with the big picture. Walk us through how the week unfolded.
So, the week actually started on a calm note. It was a holiday shortened week in the US. We had had the softer US inflation data. CPI had come in gentler than expected the Friday before. Markets were feeling good, expecting the Fed might cut rates a bit more than previously thought.
So, things looked okay at the start?
Briefly, by Monday and Tuesday, oil prices were jumping around as Iran's Revolutionary Guard started military exercises, which markets don't love. Initially, there were some cautiously upbeat comments out of US Iran diplomatic talks, and everything reversed. Oil dropped, gold dropped, Bitcoin dropped. Markets thought maybe cooler heads were prevailing,
And then?
and then it became schizophrenic. Good US industrial production data, a tech rally driven by a deal between Nvidia and Meta, semiconductor stocks loved it. But then the FOMC minutes came out. Those are the notes from the Fed's January meeting, and they had a noticeably hawkish tone. Several participants floated the idea of potential rate hikes if inflation doesn't cooperate. That's not what markets were hoping to hear.
And then Iran came back into the picture?
Dramatically so. An op ed in Axios warned of a potential military confrontation, and geopolitical anxiety reignited. Oil bounced sharply. Brent crude up 4% on a single day. And by Thursday, President Trump issued a direct ultimatum to Iran with reports of US military deployments. The S&P 500 fell, European stocks fell, and oil recorded its largest two-day jump since October last year. Markets don't like ultimatums when they involve the world's fourth largest oil producer and a key shipping corridor.
And the tariff ruling, that was Friday?
It was. The US Supreme Court ruled against the administration's use of the International Emergency Economic Powers Act as a legal basis for the tariffs. Now, this is the statute Trump had been using to justify sweeping tariff powers. The court saying no created genuine policy uncertainty because the market immediately started asking, what's Plan B? The administration signaled replacement measures were coming, but there are a lot of unknowns: exemptions, scope, fiscal impact. So we went from tariff certainty to tariff fog, which markets don't love either.
A good old-fashioned fog of uncertainty.
Markets can price almost anything, except we don't know yet. Luckily, we didn't have to wait for long. You can always trust Trump's temper. He announced Saturday that he will start applying 15% global tariffs, up from the initial 10%.
Let's dig into the developed markets. Starting with the US, what's the state of the economy underneath all this noise?
Underneath the noise, actually fairly solid. Fourth quarter growth figures came in at 1.4% annualized, but that was dragged down by roughly a full percentage point from the government shutdown. So the underlying picture was better. Private domestic spending grew 2.4%. Business investment was healthy. January industrial production beat expectations.
That sounds pretty good.
It is, but here's the tension. The same strong economy that's reassuring on growth is making the Fed nervous on inflation. Core CPI came in softer than expected in January, which was welcome. But the December PCE numbers, which is the Fed's preferred inflation measure, were running at 3% year on year on the core. And the FOMC minutes made clear they are in no rush to cut rates. Some think we get just one cut this year, some say two. Markets are pricing roughly 58 basis points of cuts by year end.
So rates are staying higher for longer?
That seems to be where we're headed. And the 10-year Treasury is sitting at around 4.08%. which has come down from recent highs, but isn't going anywhere lower fast.
What about Europe? There's been a lot of talk about European economies finally picking up steam.
Yes, and this week provided some genuine evidence. The euro area flash composite PMI, think of it as a broad temperature check on business activity, came in at 51.9, which is above the 50 line that separates expansion from contraction. Germany specifically surprised to the upside. And separately, negotiated wages in the euro area rose to nearly 3% year on year in Q4, which tells the ECB that price pressures from labor aren't fully resolved yet,
So the ECB is staying put?
for now. Most banks expect the ECB to remain on hold through 2026, with some not seeing the next move as a hike until mid 2027. There's also an interesting sideshow. Reports circulated that ECB President Lagarde might depart early. The ECB pushed back, and most analysts think it's unlikely to change policy direction materially regardless.
Last year, it was around this time. We had the big defense spending headlines out of Germany and Europe as a whole.
Yes, Germany's fiscal posture has shifted meaningfully. Federal spending is expected to increase by around 45 billion euros, roughly 1% of GDP in 2026, driven by investment and defense. And the EU's SAFE facility, which is a 150 billion euro loan fund for defense, has already had 16 of 19 member state plans approved. The European defense story is very much a real market theme now.
Switching to the UK, softer week.
Mixed. The labor market was notably weak. Unemployment rose to 5.2%, the highest post pandemic level, and the largest non recessionary unemployment increase since 1982. That pushed expectations for a Bank of England rate cut in March up to 79%. But then February PMI data came in strong, composite at 53.9, and January retail sales surprised to the upside, so the picture on growth is actually decent. CPI came in at 3% headline, which is the lowest in 10 months, but services inflation remains sticky. The Bank of England's March meeting is very much live.
And Japan?
Japan is quietly fascinating right now. January inflation came in slightly below expectations, headline 1.5%, which the Bank of Japan interpreted as confirmation that early 2025 price pressures were temporary. But despite that, the BOJ has a growing chorus of hawks on its policy board who want to hike rates sooner. Governor Tamura made hawkish remarks earlier in the month, and board member Takada is expected to push for early hikes.
And the yen?
The yen strengthened earlier in the year, but gave some back this week, with dollar yen bouncing back to the mid 150s from 152 as US data came in stronger. There were also notable foreign purchases of super long Japanese government bonds in January, 2.2 trillion yen, which provides some support.
Let's talk currencies and commodities, and I have a feeling oil is going to dominate this section.
Somewhat inevitably. Brent crude closed the week at around $72 a barrel, and the journey there was a roller coaster, up on Iran tensions, down with diplomacy optimism, sharply up again midweek when the Axios op-ed landed, and then further gains with Trump's ultimatum, the largest two-day jump since last October.
But is this more noise than signal?
Some believe the strength is geopolitics driven and not reflective of fundamentals. They actually forecast sizable supply surpluses later this year, suggesting oil is likely peaked around current levels, and production cuts will be needed to keep prices from falling towards $60 a barrel.
Gold similarly bounced around?
Gold reversed sharply when Iran diplomacy seemed constructive, down over 2%, then recovered as tensions reignited. On currencies, the dollar is still resilient, but facing headwinds. The euro is showing some strength on positive sentiment figures. Sterling was on the back foot early in the week due to labor market weakness, but recovered on the PMI data. And copper is at all-time highs, with the recent pullback viewed as a technical correction rather than a demand concern.
Emerging markets, they have been going strong. We mentioned that many times.
Yes, we have. EM equity funds saw another week of inflows, sixth consecutive week positive, with about $5.8 billion coming in this week alone. Real rates in many EM countries remain attractive, and monetary policy frameworks have generally been disciplined. The overall backdrop is supportive.
Let's go country by country. Starting with China,
China is quietly executing its reflation story. Growth target for 2026 is expected around 4.5 to 5%. What's interesting is the FX dynamics. Chinese exporters have been converting dollars into yuan at an elevated pace. Capital account inflows hit a record. Some analysts expect further renminbi appreciation.
India,
India had a busy data week. January WPI inflation edged up to 1.8%, and the trade deficit widened sharply to $34.7 billion. That's a significant jump from $25 billion in December, and worth watching. Unemployment ticked up slightly to 5%. On the positive side, growth forecasts remain. The RBI is expected to stay on hold through most of the fiscal year, with any hikes not until 2027 at the earliest.
let's switch to Turkey and Egypt, your two very unlikely favorites.
Other than Iran related tensions, we had little macro news on both. On Turkey, the positive signal is the fiscal position. The 12-month rolling primary budget surplus improved to 0.7% of GDP in January, which is a meaningful improvement and reflects ongoing fiscal discipline. On FX, most banks are short dollar lira, which is a vote of confidence in Turkey's monetary orthodoxy holding. For Egypt, the story this week is mainly in the positioning. Everyone likes being short dollars, long EGP, which is why we saw significant volatility in offshore NDFs during the week on Iran tensions.
Fair enough. South Africa,
South Africa had a relevant CPI print. January came in at 3.5% year on year, which was slightly above expectations but down from 3.8% in December. Core CPI at 3.4%, still well within the SARB's target band. A rate cut in March is likely, and the budget due next week is expected to show further deficit compression. The fiscal story has improved meaningfully.
tell us more about the budget expectations.
The South African national budget is due, and it's expected to be a genuinely positive story. The headline numbers point to a main budget deficit of around 4.2% of GDP, with debt to GDP firmly trending downward from 2026 onward. Because revenues have overperformed so significantly, the government is expected to drop its previously signaled plan to raise taxes by R20 billion, opting instead for a more growth-friendly stance. The structural reform commitments around energy, logistics, and water infrastructure will be closely scrutinized. Markets are watching whether the budget reinforces the credibility of the fiscal consolidation story. And if it does, that's positive for the Rand and South African bonds.
What else is on the calendar for the week ahead?
Two big themes: US politics and European inflation data. President Trump delivers his State of the Union address on Tuesday, and given the week we've just had, tariff court rulings, Iran ultimatums, the market will be listening very carefully for any signals on trade policy direction and what replaces the tariff framework.
And on the data side?
Germany's IFO business sentiment on Monday will tell us whether confidence is holding. Then European flash CPI prints land Friday: Germany, France, Spain, which will feed into the ECB's read on the disinflation path. In the US, the PPI print on Friday matters because it's an input into the core PCE calculation. And core PCE is what the Fed actually watches.
Any central bank action?
Several speeches to watch. Fed Governor Waller on Monday, who dissented in favor of a cut at the January meeting, but may sound more hawkish now given he didn't get the job. ECB President Lagarde speaks twice. And on the BOJ side, board member Takata speaks on Wednesday. He's a known hawk and his language could move yen expectations. Also, the BOJ is expected to nominate successors to two policy board members, which is seen as a litmus test for Prime Minister Takaichi's stance on monetary policy independence. On the corporate front, Nvidia reports, always significant given how central AI spending is to the current market narrative.
A full week. Selim, thank you as always. Sharp as ever.
Until next time.
Don't forget, folks, we do not give investment advice. For that, please consult a professional. See you next week.